Friends, the topic of this video is what should you do with Franklin Templeton Equity Funds? Firstly, my disclaimer. Neither me nor my firms have exposure to Franklin Templeton as a fund house. My views are purely academic and in response to what several mutual fund industry professionals have asked me to do. This is somewhat unusual for me because I generally avoid talking about specific products. But in this case, there is ample investment merit to speak one's mind on this issue. Firstly, the story of Franklin Templeton Equity Management is not in any way comparable to what happened in Franklin Templeton Debt. Historically, this fund house has an approach of investing which delivers over extended periods of time. I have invested and advised on these products till January 2018, and we exited most equity assets in January 2018, and our exit in Templeton was also part of an overall exit strategy from several multi-cap and small cap, mid-cap funds. But what really matters now to your investments in Franklin Templeton equity are the following. 1. Quality of the current investment portfolio. 2. Liquidity of the current investment portfolio. 3. Future prospects of the current investment portfolio. 4. Investment metrics of the current investment portfolio. 5. Effort and capacity of the fund manager to pull a portfolio into a high performance zone. On all these metrics, I'm going to share my perspective on a few Franklin Templeton funds. First, we'll talk about Franklin Templeton Bluechip Fund. This fund has suffered in the recent years for a few reasons. First, exposure to a few stocks in the financial sector which did badly. Second, avoiding owning Reliance Industries. Third, owning a high weightage of Bharti Airtel. While the first thing was a mistake, the subsequent actions in my view are prudent investment actions, and I would never blame a fund manager for that. I believe that conviction is bound to pay off, and the only issue was the weightage in Bharti and the extreme under ownership of Reliance. This is a risk which a fund manager could have avoided. But let us look at what the fund manager has done subsequent to that. And let us talk about the current portfolio. First, the current portfolio has the highest quality in my perception among its peers. So, if you look at the quality of the portfolio, there is no serious reason for us to panic. The quality of this portfolio should deliver stable investment performance over the coming years. The effort made by the fund manager to change the portfolio over the last 14-15 months are clearly visible in this portfolio, and you have to only look at the lineup of top stocks. The top 5 stocks are there. You have ICICI Bank, SBI, Axis Bank, Bharti Airtel and HDFC Bank. So it has a high focus on financials, which is again very closely mirroring the Nifty, but there is a subtle difference in the mix, which I believe should favor investors when the economy recovers. The next 5 is again a very interesting mix. You have Larsen & Toubro, NTPC, Infosys, GAIL and ACC. Here again, there is a clear value-oriented approach in the second 5. Together, these 8 stocks own 59% of the portfolio, and then you have a number of high-quality companies which they are owning, smaller size positions which will deliver performance to the overall portfolio. So, overall the strategy has been very conservative, but I would say reasonably correct. The second point on which I would judge this portfolio is on liquidity. This portfolio owns ample quantities of liquid stocks. It has an AUM of 6,000 crores. I don't see any problem of liquidity in this portfolio. The third point is on future prospects of the current portfolio. Here I think this portfolio scores very well. It scores better than several performing funds of 2020. The reason is the value orientation of the fund manager and his ability to pick stocks which will benefit in an economic recovery. Even while playing banking, he has a very different lineup which I believe will perform in a better way in the future. So effectively, the portfolio construction is reasonably favorable and should do well in the next 1 or 2 years. So the future prospects of this portfolio look very promising. The next point is on investment metrics. Most people do not go through investment portfolios of mutual funds on serious investment metrics. When you don't follow investment metrics, what happens is your opinions are more subjective than objective. Investment metrics do not give you that room, right? You have to look at the future earnings of the portfolio. You have to look at how the portfolio performs on dividend yield. You have to look at the overall portfolio multiple. You have to look at the weightages of stocks, and you have to look at how the risk weighting of stocks has been done and how it will perform in the future. So when you look at all these metrics, my overall sense is that this portfolio has been reconstructed very sensibly over the last 1 year. While there has been a massive crisis on the debt side, I believe that this portfolio has gone through a very interesting transformation and has positioned itself very well on the investment metrics front. When the investment metrics front is right, I believe that you must allow the portfolio to run for reasonable time before you judge whether you should exit it. If the metrics are wrong and if they don't give you positivity, then it's an entirely different judgment for you. But I believe that given the current investment metrics of this portfolio, the overall harmonic PE, the Piotrowski score at the portfolio level, and several of these things which we look at, I believe that this portfolio is well poised on the investment metrics front. Lastly, the fund manager's capacity. Experience cuts both ways. On the one side, experience can bog you down. It doesn't allow you the luxury of taking risks which other younger people are willing to take. It doesn't allow you to throw yourself into buying into overvalued stocks. It doesn't do many things, but it gives you one very important ability, and that ability is to fight back on your terms and build your portfolio back sensibly without playing too hard, without taking too much risk, and without endangering the investor. I think this is a very undervalued trait in our mutual fund industry, but in my assessment, this is the most important trait for a retail investor because it's for him that we are doing our investments. On that score, I believe that this fund has performed admirably over the last 1 year, and the fund manager has tried very hard to position it correctly. I believe that given this fund under the same fund manager should do very well over an extended period of time. There is no cause for an alarmist exit from the fund. That is my assessment. If I owned it, I would not sell it. And there is merit even for somebody to do an SIP or whatever way you want to participate in this fund whenever the opportunities present themselves before you, but that is your personal choice. More importantly, given that on all 5 counts, the fund does very reasonably, it has done a better effort than peers to position itself towards the future, I believe that an investor who has stayed this long must enjoy the benefits of all the hard work done by the investment team over this period and the patience which the investor himself has contributed to this investment over this period. Both these things must be rewarded and the investor must allow himself to be rewarded. That in essence is my judgment of Franklin India Bluechip Fund. The next fund scheme I am going to talk about is Franklin Prima Fund. This was one of the earliest funds which I spotted under my framework in 2010-11. It was a fund we were invested in for 7 full years and our investors had benefited enormously. I made a categorical decision to exit all small and mid-cap funds in 2018 January, just before the budget, and I have not revised my opinion on that till this day. But I want to place my observations on the current state of affairs. First, the quality of the portfolio. The quality of this portfolio is high. Naturally, when the quality of a portfolio is high, in a crowded space like mid and small caps, the valuation of the stocks owned in the portfolio will tend to be higher. So, in that sense, the Prima portfolio has a higher valuation metric, but I believe that it's mostly in line with peers. So, while they have focused on quality, valuations of the overall portfolio are higher. Overall, if you look at the portfolio, they have bought quite a few companies which are liquid and which are reasonably conservative, along with companies which are more oriented towards a broader economic revival. So, in that sense, this portfolio has a very eclectic mix both on the quality front and on the liquidity front. The mix itself ensures that quality and liquidity issues are taken care of. The future prospects of the portfolio are completely dependent on the macroeconomic recovery. If the economic recovery is faster and sustained, then this portfolio will come back much faster. But if the economic recovery is delayed, then the portfolio runs a clear risk of delayed gratification. Principally, this portfolio is recovery facing. That is the broad assessment of this portfolio, and the future prospects of a recovery facing portfolio will be better than the future prospects of a portfolio which has a lot of past biases in it. This portfolio actually has less of past biases and it has more of future orientation. So, in that sense, it is very clearly focused. Then we come to investment metrics. Investment metrics is a bit of a mixed bag in Prima. The reason is it is recovery facing. When it is recovery facing, some of the stocks which they have bought will not have good current metrics, but the metrics can come back in the future. So, when an analyst looks at it, unless he is a stock expert, he will not be able to pick this clearly. So, there is very high tendency to think that the portfolio investment metrics are not as good as they should be, but the investment metrics are not bad. The reason for the metrics being what they are is clearly the portfolio construction style, the technique and the space in which bets are concentrated. Clearly, over a period of 12 to 18 months, the metrics will jump sharply. But an investment manager cannot buy into the same teams at the same valuations when the metrics jump. So, a manager doesn't have a choice but to buy some stocks ahead of performance metrics coming in their favor. And that seems to have what has happened in this portfolio. My sense is, from a future investor point of view, you can buy when those metrics come in favor or just before, or you can buy steadily towards that. But if you're already invested in it and you spent a lot of time in getting this portfolio, by exiting it today, you're probably wasting all the time you've spent along with this portfolio, and you're also not going to get those benefits which this portfolio should deliver. You only got the benefits of a earlier version of this portfolio. This portfolio will deliver benefits only over the coming years, and I believe that that benefit is something you have to weigh carefully and not take a hasty decision. You are owning a high quality portfolio. Some of the stocks in the portfolio don't have supporting metrics on past performance, but those metrics will come in the future. But you have a portfolio which has promise. Lastly, on the fund manager's capacity, I've seen that in the mid-cap space, you need the ability to step out of the ordinary, to go beyond what everybody is doing and pick ideas. That is something which consistently I have seen in this portfolio for a very long time. And I have empirical measurement of this over the last 10-11 years. The fund management style has been oriented towards moving ahead of our times and finding ideas. Some of these have worked phenomenally well, which is why the portfolio has superb long-term performance. Some may backfire, but the ability to come back is visible in this portfolio as well. It's a fairly large portfolio, so there is no reason to lose what you have already spent, which is time on this portfolio. A little bit more of waiting will possibly deliver superior results. And the only reason why people seem to be panicking today is because of what happened in the debt side. I think that the equity investing in this portfolio has definitely done a very committed job and a very sensible job and a no-nonsense job. I believe that such fund management is not regular and usual, and if you look at it closely, that is why this fund management team has performed in this difficult product category over extended periods of time. And I have been invested in 8 of the last 11 years in this product, and I know what happens in this product category. And I am sure that someday in the future, when I believe very heavily in this mid-cap team, I would not hesitate to buy this fund. But if you've been through it, I don't think this is the time to lose faith. So that's the summary of the Prima Fund. The next fund I'm going to talk to you about is the Franklin India Focused Equity Fund. This is an 8,000 crore fund. It's got a very heavy large cap focus, and it's a very interestingly constructed product. The reasons are simple. Again, like I mentioned in some of the earlier products, a future facing product. It's got 38% banking, it's got 9% cement, which is a very high exposure. It's got petroleum of 9%, it's got telecom 6%, it's got pharma of 6%, it's got construction of 6%, and then it has got power of 5%, and it's got projects construction of 4%. So effectively, this fund is betting on economic recovery very clearly, and it's put its foot out there. It's standing outside the crease and batting for an economic recovery. And in that sense, it's a very high conviction portfolio. Okay, so how does a high conviction portfolio like this rank on quality? Interestingly, the quality of the portfolio is top notch. If you look at portfolios of this quality, which I have seen over an extended period of time, there aren't too many, and it's got a score way higher than peers. And in that sense, both the blue chip and the focused equity are running head to head on portfolio quality. I can't pick one over the other. Both are doing exceptionally well. The only thing is that they are mirroring the Nifty on financials, on which I may have a personal view. But given that compulsion that Nifty has a high weightage of financials, the way in which they are representing financials in this portfolio is very, very interesting. And I think that has a fair chance of success. The next point is liquidity. I think that the liquidity is not a concern in this portfolio. They have got highly liquid stocks. 75% is large cap, so there is nothing to worry on the liquidity front. The third thing is the future prospects of the portfolio. As I said, A portfolio which bets on the economic recovery right now has superior future prospects than a portfolio which is constructed on the scenario of March 2020. So this portfolio is probably better placed than a defensive heavy portfolio. This portfolio hardly has any defensive except pharma. So in that sense, he is betting on the economic recovery, he is betting on return of growth, and he is betting in a way in which when growth happens, the rewards will be very substantial. How does it rank on investment metrics? Here again, there is a very intelligent mix of stocks which ensures that the portfolio valuation doesn't run away. It ensures that you have a good mix of large cap, small cap and mid cap, so that the mix gives good metrics to the portfolio, and at the same time it doesn't take the portfolio too much into an over expensive zone. And when the economy recovers, the stocks which actually seem to be pulling down the metrics now will deliver returns. So I think it's very eclectic in construction, and when it succeeds, it should deliver. And that success is totally dependent on the recovery. It's clearly a recovery facing portfolio, very liquid, nothing to worry. What is the fund manager's capacity? I believe that the fund manager has worked very hard not to buy too expensive stocks, at the same time buy stocks which are reasonably valued, which will get re-rated in a recovery. Ensure that you participate the most through your portfolio in an economic recovery and strike a good balance. It's a very difficult job, well done. So in that sense, this is a no-nonsense portfolio, clearly betting on the recovery, well focused. And if you have spent your time investing in this portfolio, a little more time will be taking you closer to your reward hour. So that in essence is what I think of three of the most significant products of Franklin Templeton Mutual Fund. I believe that any knee-jerk reaction to your investments in this portfolio are more reaction oriented and reactionary investing. And I can assure you, reactionary investing is not going to take you anywhere. It will not take you to a good place. It will not give you the rewards which you truly deserve. And it's more a disease of professional investing and not what genuine long-term investors must do. On merits, I believe that these portfolios should be given their due. Assess, take your own advice from a registered investment advisor and form your investment judgments. That in essence is what I have to share with you on Franklin Templeton Equity Portfolio. And thank you for watching this video. Do share it with your friends who are unduly concerned about their investments. I hope it helps them clear their fears and come to a better understanding of the situation. Thank you very much.